It seems that global financial markets are now on the threshold of a new era. Japan's status as a supplier of huge amounts of cheap money is poised to change in the near future. The key to the timing of changes in its monetary policy will be the results of negotiations on increasing wages in the country. If wage growth can outpace inflation, Japan will be in a real sweet spot for both the economy and the risk assets. The next meeting of the Bank of Japan will take place on March 19. At the end of this week, the extent of wage growth will become clear. In the future, it will boost consumer spending and thereby support Japan's economy. As it became known today that demands of the trade unions have already been met by such heavyweights as Toyota Motor, Panasonic, and Nippon Steel. While stubborn inflation in the United States is pushing back the timing of a monetary easing, Japan could end its decades-long experiment with negative interest rates as early as next week. So the Bank of Japan will take center stage of global financial interests. Remarkably, in 2024, Japan will have neither an overheated real estate market nor deflation as in China. There is also no presidential race and no immigration crisis as in the United States. Therefore, the yen has a strong chance of successfully resisting the US dollar and receiving support from a strong recovery in the Japanese economy and the new monetary conditions. Meanwhile, a different play is being played out in the United States as fears of a recession have faded. Economists and investors are again revising the outlook for the economy and inflation dynamic. Experts say that the flood of immigrants during the presidency of Joe Biden is one of the main reasons behind sticky inflation. At the same time, the index of a fresh workforce is also supporting the strength of the US labor market. Moreover, the issue of immigration could have a major impact on the campaign and how voters view both presidential candidates' stance on the issue. At the same time, hotter than expected consumer inflation in the United States in February forced markets to revise their forecast for the Fed's monetary policy. For example, investors abandoned their expectations that the Federal Reserve would begin cutting interest rates in the summer. Moreover, a new question now arises. If the American regulator is not able to control inflation, how relevant are the forecasts of 4 rate cuts this year? That's why the market's attention is now shifting to retail sales, producer prices, and the unemployment rate. And this data will be published tomorrow. Until then, the US dollar is facing tough times. Its index against the 6 peer currencies traded on Wednesday indicated between 102.84 and 103.02. In the meantime, Wall Street has set a new record this time. The main driver is now the hype around artificial intelligence, but not the prospects for the Fed's monetary policy. As a result, the S&P 500 rose to 5,173 points and tested its all-time high for the 17th time this year. On a Wednesday, the index is expected to trade in the intraday between 5,114 and 5,180. As for the euro area, investors are alarmed by the reports published today. However, the currency market has not budged. Yesterday, traders gave a muted response to inflation data in the United States, and this could be explained by their predictability and a small difference with the previous data. However, industrial production in the euro area makes everything more complicated. The previous reading was downgraded from a 1.2 to 0.2%, and also a slowdown that replaced growth turned out to be simply catastrophic. Industrial production shrank by a whopping 6.7%. Even the most pessimistic forecast predicted a decline of only -3%. Apparently, the situation in the euro-dollar pair will remain unchanged until the middle of next week, when the Federal Reserve makes a policy decision. By the way, Deutsche Bank analysts published a report the night before, in which they also noted the long-term low volatility of the currency pair, and this attributed the situation to easing concerns about the stability of the Eurozone, as well as a shift in volatility elsewhere. Today, the euro made an attempt to grow within an intraday corridor of 1.0923 to 1.0949, and the nearest support and resistance levels allocated along the lines of a 1.0900 and the high of a March 10 at a 1.0951. Oil also showed modest growth today. The price of the benchmark Brent rose from $82 to $83.80 per barrel in a few hours. Oil prices were supported by expectations of a high global demand, including in the United States, the world's largest oil consumer. At the same time, the Brent price continues to trade in the already known and narrow range of $82 to $83 per barrel, and today it has only shifted to its upper border. Considering that a strong drop in industrial production in Europe portends a decline in demand for energy, oil prices should also go down, and this again will not be a fall in value but only a shift to the lower border of the range. The high impact event, as in the case of the euro, will be the statement of the US Central Bank on the interest rate. You have watched the market review by InstaForex analysts for Wednesday, March 13. Subscribe to InstaForex TV channel, and we keep you updated on all market developments. Don't miss our videos. Your feedback is appreciated. See you online tomorrow.